The Union Budget 2025 is eagerly awaited by taxpayers across the country. This annual financial statement, presented by the Finance Minister, outlines the government's revenue and expenditure plans for the coming fiscal year. It holds immense significance as it directly impacts the financial well-being of individuals and businesses alike. This year, there is a palpable sense of anticipation surrounding the budget, with widespread expectations of significant tax relief and deductions, particularly for the middle class. The government has hinted at its commitment to easing the tax burden on citizens and fostering economic growth. Experts and analysts predict that Budget 2025 will introduce a range of measures aimed at simplifying the tax structure, boosting disposable incomes, and encouraging investments. These measures are expected to provide much-needed relief to taxpayers who have been grappling with the economic impact of recent global events. The budget's focus on tax relief is seen as a positive step towards stimulating consumer spending and revitalizing the economy. The anticipation stems from the government's recognition of the need to provide relief to taxpayers, particularly the middle class, who form the backbone of the economy. With rising inflation and the cost of living, the middle class has faced significant financial strain in recent years. The expected tax breaks are seen as a welcome move that will not only ease their financial burden, but also boost their purchasing power, ultimately contributing to economic growth. As the date of the budget announcement draws closer, taxpayers eagerly await the details of the proposed changes. The government's focus on tax relief is a positive sign, signaling its commitment to supporting the financial well-being of its citizens and creating an environment conducive to economic growth. It remains to be seen how these expectations translate into concrete measures and their impact on the lives of ordinary taxpayers. One of the most significant expectations from Budget 2025 is a revision of the income tax slabs. Currently, the basic exemption limit stands at 3 lakh rupees, meaning income up to this amount is exempt from taxation. However, experts predict that the government might increase this limit to 5 lakh rupees, providing a larger chunk of income tax-free to individuals. This proposed change in the basic exemption limit is expected to be accompanied by a revision of the entire tax slab structure. One prominent suggestion comes from TV Mohandas Pai, a well-known industry leader who proposes a simplified structure. No tax on income up to 5 lakh rupees, 10% tax on income between 5 lakh and 10 lakh rupees, 20% tax on income between 10 lakh and 20 lakh rupees, and 30% tax on income exceeding 20 lakh rupees. This revised structure aims to make the tax system more progressive and provide relief to taxpayers across different income brackets. The rationale behind this proposed revision is to simplify the tax structure and reduce the tax burden on individuals, especially those in the lower and middle income groups. A higher basic exemption limit and revised tax slabs would mean that individuals have more disposable income, which they can then spend or invest, thereby boosting the economy. The existing tax slab structure has been criticized for being complex and burdensome, particularly for those in the lower income brackets. The proposed revisions, if implemented, would simplify the tax calculation process and make it easier for individuals to understand their tax liabilities. This move towards a more transparent and straightforward tax system is expected to be welcomed by taxpayers across the board. The anticipated tax relief measures in Budget 2025 are particularly significant for the middle class, a segment that has witnessed a considerable increase in its tax contributions in recent years. Data reveals that individual tax collections have almost doubled from 4.8 lakh crore rupees in fiscal year 21 to 10.4 lakh crore rupees in fiscal year 24, indicating a substantial rise in the tax burden on individuals. This surge in tax collections from individuals, particularly the middle class, highlights the need for tax relief measures targeted at this segment. The middle class plays a pivotal role in driving economic growth through consumption and investment. By providing them with tax breaks, the government aims to increase their disposable income, which can then be channeled back into the economy, fostering a virtuous cycle of growth. To illustrate the potential savings from the proposed tax slab revisions, let's consider an individual with an annual income of 25 lakh rupees. Under the existing tax regime, assuming standard deductions, their tax liability would be approximately 4,99,200 rupees. However, with the proposed new slabs, their tax liability could reduce significantly, resulting in potential savings of around 1,51,700 rupees. Similarly, under the new tax regime, the same individual with a 25 lakh rupee income currently has a tax liability of 4,34,200 rupees. With the proposed changes, their tax liability could further reduce, leading to potential savings of approximately 86,700 rupees. These examples demonstrate how the proposed tax slab revisions could lead to substantial savings for middle-class taxpayers, increasing their disposable income. While revisions to income tax slabs are a key expectation, Budget 2025 is also anticipated to introduce other measures to provide tax relief and boost specific sectors. One such expectation is an increase in the deduction limit under Section 80D of the Income Tax Act, which pertains to health insurance premiums. Currently, individuals can claim a deduction of up to 25,000 rupees, while senior citizens can claim up to 1 lakh rupees. There is a growing demand to raise this limit to 50,000 rupees for individuals and 1.5 lakh rupees for senior citizens. This proposed increase is seen as crucial in encouraging more people to opt for health insurance coverage, particularly in light of rising healthcare costs. By providing higher tax deductions for health insurance premiums, the government can incentivize individuals to prioritize their health and financial security. Another area where taxpayers are hoping for relief is in home loan interest deductions under Section 24(b). The current limit for claiming deductions on home loan interest is 2 lakh rupees. There are calls to increase this limit to 3 lakh rupees, which could provide much-needed relief to homeowners and potentially revitalize the real estate sector. A higher deduction limit would reduce the effective cost of borrowing for homebuyers, making homeownership more affordable and encouraging investment in the real estate market. Furthermore, there are expectations that the government might enhance the deduction limit under Section 80C of the Income Tax Act, which covers investments in various tax-saving instruments like Public Provident Fund, PPF, and tax-saving fixed deposits. The current limit of 1.5 lakh rupees could be raised to encourage individuals to save more for their retirement and other long-term goals. By providing tax benefits for such investments, the government can promote a culture of saving and financial planning among citizens.